I'm a CFA charter holder, Chartered Financial Analyst. It's this designation that focuses on being able to determine, say, intrinsic value of securities. So I work specifically in investment management. I would advise clients on how to invest their assets and how to diversify and how to build out an investment policy statement. So I was doing that for years before getting into full-time into the crypto space. And it's not any direct observations that I've made, but I could point to the Wolf of Wall Street, right? Trading penny stocks and the way that so market manipulation is essentially either price information or even disinformation going out that makes the market move in a way that it wouldn't normally move. And then it's being a predator on that type of behavior. Pump and dump is a very common term. You inject liquidity on a low liquidity asset, the price moves up a lot, you make a lot of noise about how much it's moved, people come in to buy, and you dump all your shares. That's one of the most common forms. But there's all different types of market manipulation that takes place on exchanges, spoofing orders, tricking people. It's deceiving people and misleading them about the actual dynamics of the way that a market operates. And people are emotional animals, and so they will react to these types of things. And you have sophisticated insiders that maybe understand exactly what's going on, preying on the people that don't understand as well. And so, again, not any direct observations from me, but just seeing this type of market activity through time. If it smells fishy, it probably is.
You mentioned spoofing on exchanges?
Yeah.
What is that?
So spoofing is placing large artificial orders. It could be on, say, the sell side or the buy side. And what that does is people see this large order on the books and they believe that liquidity is there now, right? And so they're saying, or they say, oh, wow, somebody wants to put $1 million into this asset. I'm going to buy it because obviously people want to buy this thing, and I'm going to buy it above the order, that big order, so that I can get in. And then as soon as people start buying it, they pull their orders. Their orders were never intended to actually buy, but rather to mislead people into thinking that these big orders exist. And again, that could happen on the sell side of the book or the buy side of the book. And it's not necessarily the exchanges that are doing it, it's the people that are participants on those exchanges. In traditional markets, something like that is far less common because that is detectable. The crypto markets, as we know, are still this evolving industry, and regulation is relatively uncertain. So, and in particular, if you look at, say, decentralized exchanges, which I am an advocate for, well, there's nobody that's really supervising the activity on the decentralized exchange. So things like this, people can get away with.